Hi, this is Judith Peckett, and this is Inventory Part 1. We have a whole chapter dedicated to physical inventory, costing of inventory, a concept called lower of cost or market, and then understanding errors in inventory and calculating and interpreting the inventory turnover ratio. For the first time, we are comparing merchandise and manufacturing companies, and we just kind of want to talk about the two forms of business that use inventory. Merchandise companies buy and resell inventory, and they have one inventory account. You can use merchandise inventory or you can just say inventory. Just be consistent. Manufacturing companies have three inventory accounts: raw materials, work in process, and finished goods. And you'll be working more with these types of companies, manufacturing companies, when you get into management accounting. Taking a physical inventory, as a review, we have to take a physical inventory whether we use perpetual or a periodic system. If we're doing perpetual, we just want to compare the accuracy of the book to the physical inventory, and any differences we know are lost, wasted, maybe there was theft, shoplifting, or employee theft. For the periodic system, we have to determine the inventory on hand. That's the only way we can find out what's on hand, and in so doing, we determine the cost of goods sold for the period. So one of the things about physical inventory is trying to figure out who owns the goods. And there's two situations we want to talk about. One is goods in transit, and one is consigned goods. So goods in transit means these are goods that are actually not received. They are in transit. They are on a truck coming from the seller to the buyer. Or if they're a return, they're coming from a buyer to a seller. But we're going to talk about the shipment to the buyer. Goods in transit should be included in the inventory of the company that has the legal title. Legal title is determined by the terms of the sale. So remember, we had FOB shipping point and FOB destination. FOB shipping point means title transfers at the shipping point. The buyer owns during transport. Therefore, the buyer includes goods in transit, if they have FOB shipping point, in physical inventory. FOB destination, title transfers to the buyer at the destination. So the seller owns the goods during transit, and these goods would be included in the seller's physical inventory count. The other situation is consigned goods. Consigned goods are where a seller puts his goods in another shop, not a shop owned by the seller. The shop's job is to try and sell the goods for a fee. They'll get a fee, but they never take ownership of the goods. Consigned goods belong to the inventory of the consignor. The consignee, the shop, the store, the Red Chair consignment shop, Gale's consignment shop, does not own the goods. They are just selling the goods. So when it's time for physical inventory, the Gale's consignment shop should not include items that belong to the consignor. How much inventory should a company have? Well, that's a wonderful question. Who knows? You only ideally want to have enough inventory to completely meet your sales needs. You don't want to have a lot of excess inventory because that means you're going to have to figure out where to store it. If you had to borrow money to buy the inventory, you may have to pay interest, and there's always the risk that an item will go out of style, fashion will change, or that it will become technologically obsolete. How do we assign cost to inventory? We know and we've learned all the inventory costs: the original purchase, the freight costs, the purchase returns and allowances, purchase discounts. But once we buy all the inventory at different times, how do we know which inventory and at what cost sold? We have to make cost flow assumptions. And why is that necessary? Because of changing prices. You may buy inventory in 3 separate purchases, and the price will not be the same for each purchase. And you have to decide which assumption are you making to value your inventory when it's sold. This ends part 1. Next video will be part 2, cost flow methods.